Good afternoon again. Jeff Benson coming to you from Jacksonville, Florida today. Once again, I'm glad everybody could take some time out of their day to learn a little bit about builder's risk. It's one of my favorite things to talk about. This is an ongoing series of webinars. We've been doing this for quite a while now. What we'll do is for about 20 minutes, we'll go through the PowerPoint, and then we'll open it up to questions. And what's interesting about these things is we've really turned them more educational than marketing. So these are kind of industry, the line of business, things that we know about. And this has been an interesting one putting this webinar together because we asked all of you, what do you want to talk about? So some of this is being driven by the people that are on the webinar today. And the other thing we've done from our builder's risk underwriting unit down here in Jacksonville is I went to the underwriters and said, what are the questions we get time and time again? Now, another thing that's very interesting to me is that these questions, if we do this a year from now, there'll be 10 different questions. And there's a lot of reasons for that. It can be driven by the lending institutions that are requiring different things. It can be driven by the ISO, AAIS forms changes. It can be driven by technology changes in the building industry, using drones and whatever else they're up to. So there's a lot of things that change on the questions that we get time and time again. So what we're going to do is go through these 10 questions, and I'll give you a little insight into, what these questions mean and try to answer them for you. And then we'll ask any questions you have above these. So without further ado, let's jump into it. Don't know about this picture here. This home's maybe it needs a little work, but what is replacement cost for builder's risk? I hear this almost daily. So first of all, let's talk about ground up new construction builder's risk. They're building a home, they're building an office building, and let's just say the contract or the form is an actual cash value form. So then you got to say, okay, what is the definition of actual cash value? So actual cash value is replacement cost minus depreciation. So let's do a little logic here. We'll put a little, C equals C together. So if you're building a new structure, there's no depreciation. So if you take that out of the formula, replacement cost equals actual cash value. So for ground up new construction, there is absolutely no difference between actual cash value and replacement cost. Get that question every day. I mean, if you don't believe the carriers, you get it in writing. That's the way they adjust the claims. There is no depreciation for ground up new construction. Some carriers have changed the wording just to appease the lending institutions, but there is no difference in coverage. Now, on the other piece of builder's risk, when you get into renovations and you're going to insure existing structures, and now we have an issue. So we have a 100-year-old building, and maybe the lending institution or the builder, somebody's going to ask you to insure that for replacement cost. I think you might find it very difficult to find an underwriter to write replacement cost on a 100-year-old building. It'd be very difficult. So it's probably an ACV contract. But the other thing that you might want to look into for AAIS carriers is the stated value form. And basically what that does is you agree to a value with the builder, say, here's what this building is worth, and then you write the policy for the stated value. If you do that, there should never be a problem. It used to be called agreed amount back in the day, now it's stated value. So the difference is ground up new, replacement cost ACV equals the same. Renovations, existing structure, try to do it on stated value if you can. It's a better way of doing it. Why is the policy issued for the total completed value? Well, first of all, we got to think about, it's kind of evolved over the years, the builder's risk line of business has, and the coverage forms. Almost exclusively in the market today, it is completed value. So what completed value is defined in most forms: labor, material, overhead, profit if you want it. Sometimes some soft costs are built in, but it's really, another way of looking at completed value would be the selling price of the project minus the land. That's everything that goes into that, from labor, overhead, all of that. So selling price minus land is a good little trick to remember. But why is it issued for that? So if you're the risk taker, you're an insurance carrier, and you're writing builder's risk, the rate is promulgated on the project going from 0 amount of risk when it starts to 100% when the building's completed pending closing. So the rate's pretty low per 100 in the most case. So the carrier has to collect the money up front. So I get the money when the project first starts, and there's very little risk. But knowing that as the project goes on, the risk grows for the carrier. But I've already collected that money in the beginning. So that's the whole premise of completed value. I had an agent the other day bring me an account, and they said, well, it's 90% done, so you should insure it, Jeff. It's a great deal for you. And I'm like, well, wait a second. I didn't insure this thing, and so now it's 90% done. Now you're going to pay me the premium, and I have all the exposure because the project's almost done. I didn't get the benefit of sitting on that premium while the project was being built. So that's why most underwriters, depending on the circumstances, don't like insuring projects that are too far along. But once again, talk to your underwriter. Maybe they can debit rate it. Maybe there's something they can do for you depending on the individual project. But that is why the policy is issued on total completed value. Who should be the named insured? All right, so let's kind of go to the basics of property insurance. Any entity that has a financial interest in the property could be an insured, correct? So that's kind of the premise of property. If I have a financial interest, for the most part, there's two entities involved. All right, we'll say three entities involved in builder's risk. One is the builder, general contractor, is building the structure. Two would be the owner or the developer of the structure. And I guess you could throw in the subcontractors. They have an interest too. So those are the three entities. So what I would usually see is the named insured is the builder. You add the owner as an additional insured, or you can flip-flop those and just make sure the form includes the interest of subcontractors. You don't have to add all of them. They're automatically included as long as their interest is automatically included in the policy. So hopefully that explains who the insured should be. Keep in mind our last webinar was on general liability and builder's risk. That's a whole nother can of worms. Property is a little more simple. Financial interest, then you can be an insured. How does coinsurance apply to builder's risk? This is something that I still get, and it's one of the basis of all property insurance. But I'll go back to my early training days of in the marine underwriting many years ago. We won't talk about how many years ago. But what is coinsurance? It's did over should have times the loss, right? So what did you cover it for? What should you have covered it for times the loss? So coinsurance is just like that in builder's risk. If you have an 80% coinsurance clause and it's a completed value form, you have to insure the project to 80% of the completed value. And once again, you got to go to the form to see how completed value is defined. But like I said, labor, overhead, material, labor, overhead, material, soft costs might be included in that, and they might not be. You have to kind of look at the form to see that. But that's how coinsurance is on builder's risk, so make sure. I have seen a lot of carriers in the marketplace today that will waive coinsurance on ground up new construction. Because you got to think, hopefully they're insuring that for the right amount of money. And a little warning to all the agents out there too, I would not encourage knowingly underinsuring anything. It creates a headache for the claims people, for the carrier, and ultimately for you. Once again, two worst letters that you guys ever hear are E and O. So make sure we do not underinsure knowingly. How do you determine the existing structure value? Now, this is more of remodeling, renovations, and you're going to insure the existing structure. I always encourage the agent, when in doubt, pick up the phone and ask the underwriter, have a little discussion. We do so much of this here that I pretty much know per square foot how much something is worth in any given area, be it in the Northeast, which is very high, or the West Coast, which is very high, down to the Southeast, which is very low, and Midwest is kind of in between. So, you're going to go to the basic construction, occupancy, protection, exposure, and then you're going to look at, was this thing made out of? Is it frame? Is it masonry non-combustible? How ornate are the structures? Is it, a tract home is going up easily? It's a custom home. You have all those discussions that will affect the construction, the existing structure value. But once again, you don't want to knowingly underinsure or overinsure anything. I guess we could say if you overinsure it, you might create a moral hazard. We don't want to do that either. So I would say the first thing to do on anything is to pick up the phone and talk to your underwriter about the proper values, and talk to the builder. they're going to say, I got a great deal on this. I don't want to insure it for very much. So don't fall into that trap. Is profit covered? You get asked that all the time. So a builder's building 5 houses a year. So to keep it simple, he's going to make 20% of his profit for the year on each house he builds. So if he has one of those houses burned down, it's 100% complete pending closing, and the home burns down and he did not have profit coverage, he just lost 20% of the income he would have made for the year. So that's a pretty good hit, especially when he finds out for a couple $100 he probably could have insured that profit. He might not be real happy with you. So I would say explain to him that profit can be included, but it needs to be included in the completed value of what you wrote the policy for. And just make sure the coverage form that you're selling includes profit. So if it's a contract home or a contract project where the profit's built in, that's pretty easy. If it's a spec house that's being built, we're starting to see more and more of those come back now. Kind of tells me the economy is doing pretty well in parts of the country. So if it's a spec house, and that one happens to burn down, he goes, I make 80% profit. Most of the time in the form, it'll say, what is your normal profit margin? So they'll go back and look at historically, what have you made on these homes? You make 10%, 15%, 20%. And on the one that burned down, you're asking for 20%. If that's your normal historic profit margin, there shouldn't be a problem. We don't want to create that moral hazard where we pay too much on that thing. So, but profit is not automatically covered. It needs to be included and pay an additional charge. How do change orders apply to builder's risk? I see this all the time because completed value is just that. We're going to say you're going to build $1 million home, so you write the policy for $1 million. Halfway through the project, the owner decides they'd really upgrade the flooring, they want to upgrade the windows, they want to upgrade the countertops, and now the $1 million home becomes the $1.5 million home. So what you need to do in that case is immediately notify the carrier. Say, the $1 million home is now $1.5 million. And so what the carrier will do is say, okay, we can adjust it to $1.5 million, but we are going to go back to the beginning of the policy period to calculate the additional premium. Once again, you need to understand this is completed value builder's risk, and we should have been at $1.5 million, and we were only at $1 million. So you will pay the additional premium on that $500,000, but I would recommend doing it immediately when you become aware of it. There are some carriers that offer what we call contract change order coverage that would automatically include some of these contract change orders. I would recommend looking into that. It's a good way of kind of buffering yourself, kind of like an inflation guard type thing. So I would always look into the contract change order coverage. But once again, it happens. Now, if the $1 million project becomes a $3 million project, I have a feeling we didn't understand what we were insuring when we started this thing. So there is you might have to answer some more questions. The one thing that from an underwriting perspective that we worry about is that the $1 million project's now $3 million, and maybe we didn't understand the scope of the project. Maybe there's structural changes. Maybe it's a lot more ornate than we thought. So we're going to start asking more underwriting questions as the values change. What is the difference between fully earned and pro rata? Well, pretty simple. Fully earned is you've agreed to pay that, and there's going to be no return premium regardless of when the project stops. So pro rata is just that. Let's say you write a 12-month policy, they build the structure in 6 months and sell it. You're going to give them half the money back that you collected. Only warning I'll give you there from an ease of doing business standpoint, if it's a lower valued project, fully earned, it might be a better way to go, simply because now the carrier doesn't have to touch it, and you, the agent, don't have to touch it again either. Think about a $400 policy. Do you really want to get involved in trying to get a return premium and get that money back to the insured? Might be easier just to write fully earned and make sure there's a good rate going in the beginning. That's just my advice. But work with your carriers on that. Some will offer pro rata. A lot of them will the second year. Let's say it's a 15-month project. You're going to write a 12-month policy. That second year, if they don't do an extension, they might write a policy pro rata. I would rather write the policy for 15 months in the beginning and be done with it. That's just me. I'm always trying to make it easy on you, the agent, and me, the underwriter. I like this picture. Everybody's happy. It's because they're happy because we're talking about builder's risk. I like that. So how does the occupancy clause apply to builder's risk? Well, this is a can of worms, and this is where you'll find out that each form is very different. You know, you got the big boys out there, the Zurichs, the Hartfords, the Travelers, the CNAs. They have their own forms with their own occupancy clause. The regional carriers across the country have their own forms. AEIS has a form. The best advice I can give you is whatever carrier's form you're selling, you need to understand the occupancy clause. Some of the common features of an occupancy clause would be a home's being built and now the people want to move into it. So usually they give them so many days, be it 45 days, 90 days, whatever it may be. They can move in the home and the coverage is still there. But at some point, the coverage stops after they've moved into it. Another feature of most forms, though, is if it's rental property. A lot of times, if it's rental property, once somebody moves in, coverage ceases immediately on rental property. Be very careful on that. If it's a commercial structure, a lot of times it's tied to the percentage of the total square footage that's occupied. So they'll build in, 50%, it's covered. If it goes over that, it's not covered. I've seen some where it's a 4-unit building. So as long as it's less than 50%, you still have coverage. Once that third unit is occupied, coverage ceases. So I can't really tell you this is the answer for every form, but pay attention because there's a good chance, they think they have coverage and they don't. And what happens when a building is occupied? The risk exposure goes up. People are plugging in their microwaves, plugging in the toaster. Now they burn the building down, and it's too bad because there's no builder's risk coverage because the building was occupied. So be very, very careful. And the last one, which I get this question a lot, mainly in the Northeast and the Midwest, where they're doing a lot of renovations, is what if the renovation project doesn't start right away? Or even then, what if it stalls? What if the renovation project stalls midterm? Most forms now have clauses built in. Because if there's no ongoing construction activity, then coverage either ceases or diminishes dramatically. At that point, they're saying you need a vacant structure policy. So you need to stay tuned in with your builders. I don't know if you drive by the projects once in a while, or at least have conversations with them and tell them, if the project stalls, let me know. Because if it stalls for too much time, 30 days, 60 days, whatever it may be, we may have a problem. So it's all about that. The same thing with if it doesn't start right away. We've had some, where they write the policy and then the permits get held up, things happen, and it doesn't start for a year. As an underwriter, I guess I don't care if it doesn't start right. If it's a new project and it never started and you're going to pay me premium for no exposure, I guess I'll take that. But I think I would contact the carrier and say, let's put a hold on this thing. And once it starts, I'll let you know, and we can make that the effective date. That's just kind of a way of saving a little bit of money. But it's all about communication. Make sure you communicate with your insureds and make sure you communicate with your underwriters. I guess that's really the theme of the day. So that was it. That was the 10 questions that we get daily. Sometimes we get these questions multiple times in the same day. So hopefully I cleared some stuff up. We are available if you want to, talk about this later at a given time. What we're going to do now is open this up for questions. And so whatever questions you have, you can chat with us, and we'll sit tight and see what you guys come up with. Thank you for your time today.
Thank you, Jeff. So we actually didn't get any questions. Apparently you answered everyone's questions within the webinar.
Unbelievable.
But I know. I would like to talk about, so we sent out a survey to everyone. You should see it in your Voss newsletter today. But it's a link asking if anyone wants to share any specific topics that you want us to cover in these webinars. We're all ears. So let us know if you didn't get that link and we can get that to you. But we're just basically looking for some topics that you all want to hear about so we can cover them in these webinars. But thank you, everyone.
Yeah, I mean, we're here for you. Here's our contact information. Give Donna or myself a call anytime. Pick up the phone. You can email me, however you want to do it. We're here to help you out any way we can. I greatly appreciate your time today, and be listening because we'll have another one of these next month. So let's, everybody have a great day, and let's go write some builder's risk.
Thank you, Jeff. And I forgot to mention it, but we will be sending out a recorded version of this webinar as well as the presentation that Jeff shared with you in the next few days. So look out for that as well. Thanks, everyone.
Thank you.